Hello investors, welcome back. Today we'll discuss self-directed IRAs. A self-directed IRA will allow you to make investment choices outside of the traditional stocks, bonds, ETFs, and mutual funds. If you want to self-direct, you're going to have to go outside of the major brokerage houses. And the reason for this is that there's many regulations in this field, and so it's very specialized. There's a plethora of niche players. I don't endorse any of these companies, and so I'm going to ask you to do a quick internet search. You'll be able to find many. Now, the reason to self-direct is that it does give you literally so many options. If you're happy with stocks and bonds, that's fine. But if you'd like to discover the investment world outside of stocks and bonds, listen on. Most important thing about having options is, for example, you may be very interested in investing in a business, for example. Well, you're not going to be able to do that in your IRA if you have an ordinary IRA. But with the ability to choose multiple options comes diversification. If you listen to the talking heads on TV or you talk to your major brokerage houses, they'll tell you, well, diversification is about having the appropriate ratio of stocks and bonds. I'm here to break you out of that false dichotomy. Another great way to diversify would be to go into real estate. Problem is, most people don't want to deal with tenants, termites, and toilets. So stick with me and we'll return to this theme in a moment. I'll tell you how you can invest in real estate, diversify your portfolio, while at the same time not having to deal with tenants. Another great reason is returns. If you want something that returns better than the stock market, well, then you're going to have to look beyond the stock market. There are no guarantees, but if you're willing to look, I guarantee you'll be able to find investments that offer you better returns than the stock market, and at the same time may offer greater stability. Now, by all means, I'm not an investment advisor, a CPA, or an attorney. I'm here simply to provide this video for informational purposes. Do your own due diligence. Now, what sort of things can you invest in? Hard money. For the last several years, builders haven't been keeping up with the demand for new housing. That means that there's a great opportunity for flippers to help to mitigate this difference that we see between demand on the one hand and supply on the other. And they're trying to fill that gap. They need money, and they're not going to get it from a standard bank loan. This is an extraordinary niche opportunity for people with both an IRA or 401k that they're able to roll over into a self-directed IRA. You're going to be able to make loans that the banks simply can't make. Another thing you can do is invest in an LLC. Again, something you just simply cannot do with a traditional IRA. Now, what about a real estate syndication? This is a great opportunity if you want to be in real estate, you want the diversification that comes with that, and you don't want to deal with the tenants, termites, and toilets. Now, there's a catch. You have to be sophisticated. That means you have to be able to fully understand the risks that come with that type of investment. Often there'll be a minimum of, say, $50,000. But I guarantee to you that is actually a small minimum. If you want to go into real estate yourself, for example, you want to become a landlord, most landlords will tell you, you have to purchase the house outright if you want to get a decent cash flow. Also, if you decide to leverage your real estate, you're going to find, at least if you're in the single-family home space, you're going to find that you can't put that home into an LLC. And so you're going to have to suffer some legal liability that would not otherwise be the case. Real estate syndication can be the perfect option because it allows you the limited liability, similar to what you would have if you're a stock investor. And at the same time, you have generally lower minimums, and you get the full diversification that comes from being a real estate investor. At the same time, don't have to deal with the tenants, termites, and toilets. Now, with this sort of a transaction, again, you have to be sophisticated. You have to do your own due diligence. But if you're investing in individual equities already, you should be doing due diligence. If you're an individual equity investor, you should at minimum be reading financial reports. And by that, I don't mean the Wall Street Journal. The financial statements you need to understand are the income statement, the balance sheet, and the cash flow statement. If you are not willing to do that sort of work, you probably shouldn't be investing in individual equities. And Warren Buffett would give you advice that you should be investing in a low load mutual fund that offers you broad access to the market. That is to say, an index fund. Now, if you are willing to do that sort of due diligence, then perhaps being a passive investor in a real estate syndication may be right for you. Now, before you can do that, you're going to have to get your self-directed IRA. And I should probably tell you about some of the pitfalls. For one thing, there are going to be some prohibited transaction. You do not want to do anything that could be considered self-dealing. Don't buy yourself a vacation home. You will find that your IRA is no longer an IRA. You will lose the tax benefits. And one of the difficulties here is that you can't fix the IRA once it's broken. Generally, what happens is that when you make one of these prohibited transactions, you'll find that the entire IRA amount that you've transferred is now no longer a tax shelter. So be very careful. The second thing is you're going to find that there are certain disqualified persons. Essentially, that means anybody in your direct bloodline. Grandma and grandpa, your parents, and any of your children or grandchildren are off limits. Your spouse is also off limits. You don't want to be involved in any transactions that involve a disqualified person. Now, to understand the rules that govern a self-directed IRA, essentially all the rules that govern your IRA at the present moment, and in addition, you have to understand some of these specific rules. Now, your custodian may or may not be able to save you. If they see you doing something wrong, they may let you know, but they are under absolutely no obligation to do so. You need to do your own due diligence. This is clearly for people who are sophisticated and interested in doing the extra work that it takes to get the diversification and potentially the returns that come from self-directing your own money. Now, I'm going to tell you next how to self-direct. And this is simply a personal approach. Okay, I'm not a money manager. I'm just going to tell you what's worked for me. So what you want to do is, if this is something that interests you, do some due diligence, look into this a little further, and then you want to transfer your money into the IRA as soon as possible, because it can take weeks. If you don't want to pay rush fees and pay wire transfer fees, it is going to take time. So I would highly recommend that if you're going to do this, I would say, once you make the decision, transfer the money. Don't wait until you find the investment, because these alternative investments usually have a limited shelf life. And by the time you find out about the investment, you're going to find out that it's too late if you don't already have the money in your account. Now, this may sound like a catch-22. You got to have the money in your account before you find out what you're going to invest in. Well, how are you going to have your money work for you? And the answer is that most of these custodians will allow you to invest in traditional assets as well. So as for me, I invest in an index fund. And the reason for this is simple. After it takes so much time to transfer my money over, I don't know exactly what stock I'm going to invest in. Suppose I was going to do the research today. Maybe I choose stock X, Y, or Z. Well, in 2 weeks, maybe the stock goes up 15%. It may no longer be an appropriate investment. I need something that is not time sensitive. And if you're going to work with such an investment, I would highly recommend, again, a low cost index fund. So for me, that's the S&P 500. So it gives me strong price appreciation over time. And many people who are in real estate will talk down the stock market. I'm not going to do that. I think the stock market is a great place to invest. However, at least for me, it's not the only place I invest. Now, what's best about a mutual fund is that you can sell quickly when the opportunity arises. If I find an alternative investment that I'm interested in, I can sell my S&P 500 shares today if I get the order in early enough, and the money will be available tomorrow. This is simply amazing. You are able to keep your money at work for you at all times, and when you find the alternative investment, you can sell and have, well, you're doing the due diligence, right? It's going to take you plenty of time. Suppose you're interested in investing in real estate syndication. You're going to have to do due diligence on the syndicator, the sponsor of the deal, to make sure that this is somebody who you trust, somebody who has ideally been successful in real estate or at least in business. And you're also going to have to do due diligence on the deal itself. And that's going to take time. You have plenty of time to liquidate those shares and then transfer the money should you decide that this is an investment that you're interested in. Investors, I'd like to thank you for joining us today, and we'll catch you on the flip side.